Flexi cap funds get most of the attention, but there is a quieter category that has actually outperformed them over the long run, and that is value and contra funds. Like flexi cap schemes, these funds can invest across large, mid, and small cap companies. But fund managers focus on hunting good businesses that the market has temporarily mispriced. The idea is simple: enter overlooked businesses at attractive or reasonable valuations and wait for the market to come around. The only difference between these two is that contra funds can be slightly aggressive by investing a sizable amount in businesses that are set for a turnaround. This can result in higher returns, but also means higher risk. So from an investor's perspective, it makes sense to analyze value and contra funds together, because in your portfolio, they will fit as a fund that avoids the herd and looks for companies available at reasonable or attractive valuations. So how does this actually help you? To answer that, we looked at how these funds performed across recent market cycles, covering 3 sharp market falls and 2 strong rallies. Let's start with what happens when markets fall. You'll notice that during declines, these funds typically move in line or slightly below the benchmark. So don't expect strong downside protection here, just relatively better damage control. Now when markets recover, the picture starts to change. If you look at the data, you'll see that during recovery phases, value and contra funds tend to outperform the benchmark. So overall, they don't avoid market falls, but they tend to fall slightly less than the market and recover more strongly. But all of this is theory. Let's take this from theory to reality by comparing two of the biggest funds in the space, ICICI Pru Value Fund and SBI Contra Fund. Let's start with a quick overview of both funds. ICICI Pru Value Fund is the largest fund. It was launched in August 2004 and has an AUM of over 60,000 crores as of March 2026. On the other hand, SBI Contra Fund was launched in July 1999 and manages around 49,000 crores as of March 2026. For benchmarks, ICICI Pru Value Fund follows Nifty 500 and SBI Contra follows BSE 500. Now let's look at the rolling returns of these funds to understand which has been more consistent over the past 5 years. You can clearly see SBI Contra is ahead in returns. The same is reflected on consistency scores on Power Up Money, where SBI Contra is at 97 out of 100 and ICICI Value is at 91. So if you look at only returns, SBI Contra clearly stands out. But returns don't tell the full story. As we saw, SBI Contra was leading earlier, but in the last 18 months correction, it fell more, while ICICI Value has done better in the last 1 year and 18 months. Our recency score also confirms this, where ICICI Value has score of 82 out of 100 and SBI Contra has a score of 61. Now, to get better clarity, let's zoom out beyond the last 18 months and see how these funds behave during tough market phases over the past 5 years. Since 2018, there have been 8 instances where Nifty 500 fell more than 5% in a month. In 6 of these times, ICICI Pru Value Fund fell less than SBI Contra Fund, which shows it handled market pressure relatively better and protected investor capital more effectively than SBI Contra. So clearly, ICICI Value Fund has handled volatility better, and our volatility score also shows this, where ICICI Value has a score of 83 out of 100 and SBI Contra has a score of 65. By now, we've seen SBI Contra Fund is leading on returns while ICICI Value Fund is handling volatility better. So what's actually driving this difference? To understand the reason, let's look at the investment strategy of both funds. Strategy 1. Large cap allocation. ICICI Pru Value Fund invests more in large cap companies. Because of this higher large cap exposure, the fund has been relatively more stable during weak market phases. SBI Contra Fund, on the other hand, follows a more aggressive approach with higher exposure to mid and small caps. Higher mid and small cap exposure means higher upside but also sharper falls. However, in the last few years, even SBI Contra Fund has increased large cap exposure. One key reason is its rising AUM, now close to 50,000 crores, which makes managing mid and small cap allocation less flexible, so increasing large cap exposure becomes more practical. Also in recent years, both funds have maintained high large cap allocation mainly due to expensive valuations in mid and small caps. Strategy 2. Turnover ratio. In an active fund, the fund manager keeps adjusting the portfolio to capture better opportunities and maintain the right allocation. How often the manager buys and sells stocks is reflected in the portfolio turnover ratio. If the turnover ratio is 100%, the fund has completely changed its portfolio once a year, while 200% means twice. If we study the turnover ratio of both funds, you can see that ICICI Pru Value Fund has maintained a relatively low portfolio turnover ratio over the years. In the last 5 years, the portfolio turnover ratio has been lower, which suggests the fund follows a largely buy and hold approach and does not make frequent changes to the portfolio. In contrast, the SBI Contra Fund has seen a sharp rise in portfolio turnover, especially after Dinesh Balachandran took charge. The turnover ratio moved from around 207 in 2021 and 203 in 2026, which is the highest in the category. This shows SBI Contra Fund actively reshuffles its portfolio roughly 2 to 4 times more frequently than the ICICI Pru Value. A higher turnover ratio is not necessarily negative, but it shows the fund is taking more active calls. This increases both return potential and risk, which could be one reason why SBI Contra tends to fall more during volatile phases. Strategy 3. Fund managers and the strategy they follow. ICICI Pru Value Fund is managed by veteran fund manager Sankaran Narain, who has 34 years of rich industry experience, and he has been the architect of this fund since its inception. He is known for a clear contrarian style. He invests in sectors that are currently ignored, enters early, and gives them time to perform. For example, before COVID, he added exposure to telecom and metals, which performed well after 2020. More recently, when IT was under pressure, he increased allocation there as well. SBI Contra Fund is currently managed by Dinesh Balachandran, who has 25 years of industry experience and has been managing this fund since 2018. He played a key role in the turnaround of the SBI Contra Fund, and almost 95% of the AUM came in the last 5 years under his leadership. SBI Contra's impressive consistency score, as shown above, is also the result of stock-picking strategies. He is known not just for scaling SBI Contra's AUM, but also his consistent contrarian approach. At present, SBI Contra has exposure to sectors like textiles, chemicals, and telecom, where ICICI Value has no exposure. This reflects the fund manager's focus on sectors that may be out of favor today, but could perform better over time. Strategy 4. Sector and stock allocation. As per Feb 2026 fact sheets, 4 out of the top 5 sectors are common in both funds, so there is some overlap in allocation. And in both portfolios, financial services has the highest weight, which shows strong conviction in this sector. And the main difference is in IT. ICICI Value has around 11% allocation, while SBI Contra has around 6%, which suggests ICICI Value is seeing merit in IT even after the recent correction, while SBI Contra is waiting for sentiment to change, which clearly defines the difference in their approach. Both funds also have exposure in oil, gas, and consumable fuels, which can be seen as a cyclical bet. And at the stock level, there is some overlap, like HDFC Bank and Reliance. But overall, ICICI Value is slightly more concentrated with 65 stocks, while SBI Contra is more diversified with around 80 stocks. So ICICI Value Fund takes fewer, more conviction bets, while SBI Contra Fund spreads bets wider. So finally, we come to the big question. Which fund should you pick? If you are comfortable with a slightly aggressive approach within the value style, then SBI Contra Fund fits better. It can outperform in strong bull markets, but you have to be comfortable with sharper falls during corrections. Choose ICICI Pru Value Fund if you prefer a more balanced approach with higher allocation to large caps and want relatively lower downside during volatile markets. It may not always lead in bull runs, but it has historically handled downside better. You can also consider both, but if your portfolio already has flexi cap funds that are heavily tilted towards large caps, then adding another similar fund may not really add much diversification. If you're looking for other categories, we've also covered the top flexi cap, small cap, and mid cap funds in other videos. You can check them out here. For deeper insights across categories, you can explore the Power Up Money app, where our SEBI registered RIA team regularly reviews and rates mutual funds. And don't forget to subscribe to the channel for more insights on mutual funds and investing.